Welcome to this presentation on money management. This video is brought to you by Alpari. What can I say? Money management, position sizing, these two topics are simple, and yet proper application of the principles that you'll learn here will make the career of a new trader versus not doing these things will definitely break the career of a new trader. So these are two of the things I would pay the most attention to in my trading, and fortunately the good news is they're easy to understand, they're easy to do, it's not overly complicated, it's just recognizing a couple of things. Now money management, this is a phrase that's kind of a basket term for several different things that we look at as traders. So let's look at each one of these things. I would say they break out into basically three items. Number one is about planning. Now, what we're trying to plan here is not necessarily your trade. That's part of your analysis. What you're trying to plan here is planning your risk. Now, what does that mean, to plan your risk? And what this has to do with is maintaining consistency. If you're consistent as a trader, that's one of the biggest hurdles that you can overcome, and it can be done right from day one if you're thoughtful about it. So planning your risk means essentially how much of my portfolio am I willing to risk in any one position. Now, a lot of traders I hear say, well, you know, what's normal? What should I be risking? It's a personal preference. It has to do with your risk tolerance. I find that it's not uncommon to have aggressive traders in the 5 to 7% range, so they're risking 5 to 7% of their portfolio in any one trade. I've seen plenty of traders with 1 to 2% of their portfolio at risk in any single trade. One of the things you'll find in common is that the less they have at risk, typically the more positions you have on at a time. The more you have at risk, inherently, you're going to have the ability to take on fewer positions, which gets to a third point here in a minute. Now, with the percentage that I have at risk, this is something that you'll probably begin to refine over time. And I usually suggest err on the side of caution and go with the low amount initially, and don't start to ramp up too fast until you've got some good experience behind you. Now, number two is what stop losses. So how am I managing catastrophic occurrences in the market? Now I would say two things. Don't let a computer trade for you, because they're not going to be as good at it. If that were true, we'd all have computers trading for us and we'd all be millionaires. And setting a stop loss that you're intent on not touching my analysis unless that stop loss is hit, it's not always a great idea. But having a stop loss in place to protect yourself against catastrophic losses is very, very important. Now, stop losses are not arbitrary. A stop loss is based on at what point did my analysis break down. So, for example, if I've got an entry opportunity at a certain point and I know that the market is volatile and it could move against me, is 200 pips where my analysis breaks? If it moves beyond 200 pips, obviously my trade was a bad one, I need to get out. Is that where my stop loss should be? Does my analysis break if it moves 50 pips? Some of this is relative to how far is my upside. If the trade goes for me, how big is that upside? What's my relationship to my stop loss? So it will vary based on what your analysis is. What's important here is that if the unexpected, the unknown unknowns, those big breakouts that none of us can predict happens and it goes against you, you've got an emergency net here that catches your money if such a thing occurs. So it's really there for emergencies and you shouldn't be trading without it. Finally, number three is diversification. Now that means a couple of things. I find that traders oftentimes think that diversification means that they should be in more than one capital market. So they should be investing in stocks or in bonds and in metals as well as currencies. I buy into that. I think that's true, definitely. But it's even diversification within an asset class. And in this case, we're in the Forex, so we're dealing with diversification in the Forex. Here's a classic example. Going long the euro dollar and short, so we're long this one, and short the dollar franc is not diversified. This is essentially the same trade, or it's going to be very, very correlated. So we want to avoid doing things like this, because what we're doing is we're unintentionally doubling our risk. Now, if everything works out well, that's great, but if everything works out very poorly, we become inconsistent, and this is the real battle we're trying to fight. Versus if we were long the Euro USD and we were simultaneously trading the pound yen, or the CAD franc, we're starting to get a little bit more uncorrelated. We don't have the same kind of relationship amongst these three currency pairs that we do between these two. So these are three basic principles around money management. Again, not very complicated. A lot of it is just knowing what we're doing in advance. How much of our portfolio are we willing to risk at any one time? Have we applied a stop loss against every one of our positions to protect us against catastrophic problems in the Forex when we're not there, or when something is out of our control? And are we making sure that we're not unintentionally getting overweight in the same trade by trading currency pairs that are too similar in the same way? Are we spreading our risk around not only outside of the asset class of the Forex, but even within the asset class of the Forex? Now, we're going to dig in a lot deeper into how do we plan our risk in the next video on position sizing.
This video has been brought to you by Alpari.